Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining me is Phil Mackintosh, chief economist at Nasdaq. And Phil, while economic data shows many segments of the economy are recovering faster than expected, companies and consumers are still cautious.
Yeah, I mean, the markets are kind of factoring in a lot of the really good news, but there's still headwinds out there. And so today we're kind of looking at a lot of the headwinds and a lot of the impacts of the headwinds. And, consumer confidence, I think, is one of those data points that was really driving the market before coronavirus. It was supporting the services sector, and consumer confidence has not recovered really at all since the lockdowns and the shutdowns caused by coronavirus.
Yeah, and we're also seeing some movement with the current account deficit. I mean, certainly that's moving higher. That's not really a surprise to anybody.
Yeah, I mean, we talked a couple of days ago, I think, about the imports and the exports and trade, and the fact that they were bouncing, but not back anywhere near normal levels. But I remember at the time we mentioned the fact that the deficit itself had got bigger. And so today we have some data on that, and you can see it's shot up. And that's because we are obviously importing less, but exporting even less. And so we've got an increase in the deficit. It's nothing to do with the trade war this time. It's just to do with the level of activity in the economies globally.
And we're also seeing a dichotomy with goods moving higher, but services have stalled. And again, when you look at the services, it kind of goes back to the consumer and purchasing.
Yeah, and I think this is really where we're starting to see some telling signs in the data is the manufacturing sector is the sector with good data, and it's pretty much recovered to pre-coronavirus levels by lots of metrics. Today, we're looking at rail traffic, which is goods moving around America. So even though the ports are quieter because of imports, internally, we're shipping goods around pretty actively. But then you look at some of the service industries and the sort of mobility data and what that's showing. And even though retail sales looks like it's recovered to previous levels, you can see since we had the second wave of cases, pretty much every industry on the services side seems to have stalled in terms of its recovery. And that's really hurting things like malls and dining, which are big employers of people. So retail and restaurants and tourism, big employers, and sort of stalling in terms of their recovery.
Yeah, and so if we take a look at the last slide here, and really this is what it all comes down to, is that new U.S. cases have certainly not stalled. They're climbing again, and this is what we were warned about with the weather getting cooler. And it seems as if there is no coordinated response, just like the first time around, and many people will simply refuse to wear masks or practice social distancing. So, I mean, the outlook isn't too rosy there either.
Yeah, and remember, the reason we've had the sell-off the last few days is because Europe has seen a big increase in cases as everybody comes back from vacation and starts to head back to work. In the UK today, they're talking about re-implementing some shutdowns and trying to get people to avoid going to work and doing better social distancing because their cases have climbed a little bit out of control. It's kind of looking like their first wave all over again, even though hospitalizations, as we discussed, aren't so bad. So looking at the US cases, I mean, that trend that we've seen the last week or so is a little concerning because we had started to tackle the Midwest and Western states increases and it was coming down. It's still about 50,000 a day, which is not good, but that looks like it's turned. And so to your point, without a sort of coordinated approach to get cases back, and Europe, when they tackled their first wave, got cases down to very minimal levels before everybody started to travel and get back to normal and go to restaurants again. America has never tackled it that well, and we look like we might be starting, I guess in the graph looks like a third wave, but this would probably be the start of our proper second wave.
Well, so one more thing to add on there as well. I mean, the trend is quite clear as bars and restaurants have come back online and reopening even at, only 25% in many cases. The data lines up with it. The more things are opened, the more the virus continues to spread, and it just puts policymakers in a tough spot, business owners in a tough spot. I mean, we can't be locked down for another year or two until there's mass scale vaccinations available. I mean, what's the answer there?
Yeah, but at the same time, we can't be constantly worried about doing things, and so that the businesses that are going to have contact suffer anyway. So there was some research out recently, which is consistent with research from 1918 with the pandemic then, that showed that the countries that have locked down more strictly have had shorter lockdowns and more strong recoveries when everybody can get back, more likely doing things like normal, than countries like us and Britain, who have been a little bit more laissez-faire and have really struggled to get back to a point where the consumer feels confident to go and do things like go to malls and go back to work and go and do restaurant dining inside and in person. So, you know, the human factor can't be ignored, and there's a sort of short-term, greedy, long-term problem that needs to be solved as well.
All good points. Phil, thanks so much for joining us on Trade Talks.
You're welcome, Jill.
And thanks for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.